Most people believe that billionaires simply pay less tax because the rules are unfair. But the real story is far more complicated. Around the world, many of the wealthiest people legally reduce their taxes using financial strategies that most ordinary workers never have access to. In the next 5 minutes, we'll uncover how taxes really work and why being rich doesn't always mean paying the highest tax bill. The biggest difference between ordinary workers and billionaires is often where their money comes from. Most people earn money through a salary, which is directly taxed as income. But many billionaires build their wealth through ownership, stocks, companies, and investments. Their net worth can grow by billions without receiving a traditional paycheck, and that difference changes how taxes apply to their money. Here's the key idea. A billionaire's wealth can increase dramatically without earning taxable income. Imagine owning a company whose value grows from $1 billion to $5 billion. On paper, you've become $4 billion richer, but you haven't actually sold anything. Since no money has been received, many tax systems don't treat that increase as taxable income. For employees, taxes are triggered by earning a paycheck. For investors, taxes often begin only when assets are sold. So how can someone become richer without selling their assets? One common strategy is borrowing against their investments. Instead of selling valuable shares and creating a taxable event, they use those shares as collateral for a bank loan. The bank provides cash while the investments remain untouched and can continue growing in value. Loans generally aren't considered taxable income because they're expected to be repaid. This approach can provide access to large amounts of money without immediately triggering capital gains taxes. This is one of the most misunderstood parts of the tax system. A rising stock price doesn't automatically create a tax bill. In many countries, taxes on investments are generally owned only after the asset is sold and the gain is realized. As long as those shares remain unsold, the owner's wealth may continue growing on paper without creating taxable income. That's why a billionaire's net worth can increase dramatically while their annual taxable income remains comparatively low. It's important to understand the difference between tax planning and tax evasion. Tax evasion means illegally hiding income or falsifying information to avoid paying taxes. Tax planning, on the other hand, involves using legal rules and inventives that already exist in the tax system. Many wealthy individuals hire teams of accountants and tax lawyers to structure their finances efficiently. Whether those rules are fair is widely debated, but using legal tax strategies is fundamentally different from breaking the law. This is why headlines about billionaire wealth can be misleading. Net worth measures the estimated value of everything someone owns, not the amount of cash they receive each year. If the value of a company doubles, the owner's wealth may double as well, even though they haven't earned a salary or sold any assets. In many tax systems, wealth and taxable income are not the same thing, and understanding that distinction explains much of the public debate surrounding billionaire taxes. Eventually, taxes usually come into play when investments are sold. At that moment, the increase in value becomes a realized gain, and capital gains taxes may apply depending on the country's tax laws and the individual's circumstances. Until that sale happens, much of the wealth exists only as the estimated value of assets. That's why the timing of a sale can have a major impact on when, and sometimes how much, tax is ultimately paid. Whether billionaires should pay more tax is ultimately a question of public policy, not just finance. Some argue that greater contributions from the wealthiest individuals could fund essential public services and reduce inequality. Others believe that lower taxes encourage investment, innovation, and economic growth. Governments around the world continue to debate where that balance should be, and different countries have reached very different conclusions. The question isn't simply whether billionaires pay less tax, it's why. The answer lies in the difference between earning income and owning assets, and in the tax laws that govern each. These rules shape investment, innovation, government revenue, and economic opportunity. Whether those laws should change is a decision for voters and policymakers, but understanding how the system works is the first step toward having an informed opinion about one of the most important economic debates of our time.